even though uncertainty remains over how operators will be compensated for the recent holiday in toll road fees. Transportation infrastructure assets, including toll roads, airports, and ports, have been among the asset classes hit hardest during the coronavirus outbreak as global travel demand has slumped. China was the first market to be affected by widespread lockdowns during the pandemic and has now begun the process of gradually restoring normal activity. Its experience may provide insights as to how travel patterns may change in other countries as the lockdowns are eased. The most striking trend evident from China's transport data has been the strength of the rebound in road traffic. China began to ease its lockdown in February, yet by March, traffic on the national highway network was already 10% higher than in the same month a year earlier. Growth strengthened to 21% year-on-year in April. The recovery in road traffic stood in contrast to the continued contraction in retail sales, which fell by 7.5% year-on-year in April. Although fixed asset investment and industrial production returned to growth within the month, much of the strength of the road traffic data over March period has continued to experience its challenge. Currently, in China, the April month appears to have reflected the impact of the government's move to waive toll fees on the highway network, which encouraged more cost-conscious drivers to use it. As these holidays were withdrawn in May, usage of the national highway fell back below levels seen in 2019. The G20 group of nations debt suspension initiative is unlikely to ease the significant credit challenges that the coronavirus pandemic has amplified in some frontier markets sovereigns, particularly in Africa, Moody's Investor Services said in a report today. By lowering debt service payments at a time when government resources are limited and access to market financing is considerably constrained, the initiative will help to ease short-term liquidity pressures. However, debt service relief won't have a significant impact on medium-term debt trends that have worsened during the crisis. Bilateral relief would only cover a fraction of increased external funding gap resulting from the shock. While debt service relief will allow some governments to reallocate scarce resources toward health and social spending, it will not have a significant impact on weaker medium-term debt trends. Lucy Villa, a Moody's Vice President, Senior Credit Officer and reporter, gave the analysis. According to him, the coronavirus shock will lead to sharply lower growth this year, wider budget deficits and higher debt burdens for at least the next few years, as well as higher borrowing costs, at least for debt contracted on commercial terms. The prospect of significantly diminished revenue constraining debt service capacity poses longer-term solvency challenges. The coronavirus shock and the authorities' associated policy response have opened large fiscal and external imbalances that will take time to unwind. Low-income sovereigns entering the crisis with elevated debt burdens or exposure to foreign currency risk are most vulnerable. Moody's estimates that the suspension of debt service payments would reduce the funding needs of eligible Moody-related sovereigns by about $10 billion over the next 8 months. This will only cover a fraction of the external gap, leaving an outstanding shortage of around $40 billion. New official sector disbursements are expected to help fill the gap, including emergency financing from the International Monetary Fund. Speaking about the events to watch in the week, FSDH Group, made up of FSDH Holding Company, FSDH Merchant Bank, FSDH Asset Management, FSDH Capital and Pensions, Alliance Limited, is bringing together key stakeholders and driving necessary conversations regarding the pandemic and current economic situation. With over 4 million confirmed cases and over 300,000 deaths globally, the world continues to battle COVID-19. In Nigeria, the virus has spread to over 5,000 individuals in 35 states in the country since the first case on the 27th of February 2020. Although state governments have customized their approaches to dealing with the virus, its spread has brought to the light the weak capacity of our healthcare systems and how this may have heightened its effects on the Nigerian economy. In this webinar session, will be moderated by Mr. Hakeem Bello Osage, Chairman, FSDH Holding Company, at 11 a.m. on 22nd of May 2020, which is Friday this week. The group will engage His Excellency Mr. Babajide Sanwo-Olu, Governor of Lagos State, His Excellency Malam Nasir El-Rufai, Governor of Kaduna State, and His Excellency Mr. Godwin Obaseki, Governor of Edo State. The session will take a closer look at the unique impacts of the COVID-19 pandemic in Nigeria and proffer possible ways forward. FSDH Group will continue to do its part to navigate for success in these unprecedented times. Nigeria's adherence to oil production cuts under the OPEC Plus agreement will lead to deeper economic contraction and fiscal deficits and compound pressures on external finances from the slump in oil prices, says Fitch Ratings. Increased recourse to concessional multilateral loans will ease near-term liquidity pressures, but the risk of a disruptive macroeconomic adjustment will persist. Fitch Ratings assumes that Nigeria will comply fully with the production caps under the OPEC Plus agreement and have reduced its forecast oil output to 1.88 million barrels per day, including condensates, in 2020 and 1.87 million barrels per day in 2021, compared with the earlier forecast of 2.1 million barrels per day for both years. Fitch Ratings has adjusted the GDP forecast and now expects Nigeria to contract by 3% in 2020 before a recovery to 3% growth in 2021. Despite the OPEC Plus deal, Fitch Ratings forecast shows that oil will remain unchanged at $35 per barrel for Brent on average in 2020 and $45 per barrel in 2021. The contraction in exports and remittance inflows means the current account will remain in deficit despite a sharp drop in imports. Fitch Ratings projects the current account, which had been in surplus for much of the last 20 years, to record a deficit equivalent to 3.8% of the Nigerian GDP in 2020 and 2.5% in 2021. External liquidity pressures will be aggravated by outflows of foreign portfolio investments. The International Monetary Fund estimates that portfolio holdings of non-resident investors in Nigeria, which amounted to $34.3 billion at end of 2019, fell by 46% in first quarter 2020. This includes a $7 billion decline in foreign holdings of open market operation bills issued by the Central Bank of Nigeria. Nigeria's foreign currency reserves have dropped by just $5 billion over the first 4 months of the year, despite only limited depreciation in the Naira's key exchange rates. This reflects foreign currency assets. This has contained capital outflows temporarily, although the buildup of pent-up foreign currency demand may increase the risk of a disruptive future exchange rate adjustment. Fitch Ratings expects outflows to materialize later in the year, which, alongside a significant current account deficit and continued CBN resistance to overhauling the exchange rate framework, will drive a fall in the international reserves from $38.6 billion at end of 2019 to $23.3 billion by end of 2020. This level will still cover 3 months of current account payments, broadly in line with the median for B-rated sovereigns. However, at this level, reserves would offer little in the way of a buffer against external vulnerabilities, given large funding needs and an overvalued exchange rate. And that will be all for this evening's edition of COVID-19 Updates. You can visit our website www.proshareng.com to get more updates from our news stories and videos. This period, ProShare, Nigeria's leading financial information hub, has packaged for you a platform that gives you credible and reliable market data and analysis on the impact of COVID-19 on the global and Nigerian economy. Log on to www.proshareng.com/COVID-19 to get all the insights you need from the Corona Central Watch. You can also follow our social media platforms showing on the screen for further updates on our market reports. Also, in this period, the Debtors Africa launch happened recently, and yes, you can get all the analysis on this game-changing platform that brings to the fore impacts on debt management and debt recovery. Log on to www.debtorsafrica.com to get all those details you need. Till we come your way again, thank you for watching, have a nice day, and stay safe.